My topic is saving land and saving taxes with conservation easements. And I understand the session this morning queued up a question for me about mineral rights, and I want to get to that in a minute. But before I do, I want to be sure everybody understands basically what a conservation easement is. Conservation easement is kind of an unfortunate name because everybody knows what an easement is. An easement allows you to go across somebody else's land. And that's not what this is. Conservation easement is more like deed restriction. And instead of being enforced by a homeowners association, conservation easement is enforced by the land trust. And Katy Perry Conservancy is a land trust. You met some of the land trust people this morning. So you still have the right to your privacy with a conservation easement. And just the most basic thing to understand is if you grant a conservation easement to a land trust or public agency, you still own the land. It's still the land. You still have lots of rights on the land. Certain rights are restricted, and those rights are, you've given the land trust the right to enforce the conservation easement. So with that basic understanding, conservation easement is really kind of a deed restriction enforced by a land trust. I want to get to the question about mineral rights. And the question is, who asked the question this morning? Yes, sir.
Yeah, I think it was something along the lines of, I'm thinking as a landowner, if I enter into a conservation easement for my property, not owning the mineral rights, and in the future, so I've retained some kind of financial benefit from putting it into an easement via the IRS or otherwise, based on some kind of ecological function that's determined in the easement, correct? So if in the future the mineral right owner chooses to develop those minerals and by therefore causing the ecological function to be reduced, is there any liability from an IRS perspective back on the landowner that you didn't, your easement's not valid because it's not functioning in the purpose that it was set up for originally?
Okay, the determination by the IRS would not come later when the minerals were developed. It would be determined when you file your income tax return claiming the conservation easement. That's when the IRS would make the determination. So once you get past their examination period, if the oil and gas company comes in 20 years later, you're clear in terms of the IRS. In Texas, we have two types of minerals. We have surface minerals. We have subsurface minerals. Surface minerals are things like sand, gravel, stone, coal, lignite. If you have the deed to your land, you own the surface minerals unless a right to mine the surface minerals has been granted to someone else. And if someone else has the right to mine sand, gravel, coal on your property, you cannot do a conservation easement that's deductible. But I think what you're thinking about here is the subsurface minerals, oil and gas. Very often, oil and gas is severed, as we call it, from ownership of the surface of the land, your basic title to real estate. And in this case, the mineral rights owner has the right to come on your land and develop those minerals. And what we're talking about here is how the IRS looks at minerals. There are funders of conservation easements who have their own rules about minerals, but I'm thinking here about the IRS. If there are not oil and gas that's economically recoverable on your land, and you could get a certification from a geologist that you don't have oil and gas under your land, you've got a real good shot of getting your easement donation past the IRS. If, as is the case in this part of the country, there is oil and gas under the land, under a lot of the land, it's more problematic. And I don't want to say the law is uncertain about this, but the law is uncertain. However, the IRS has not been very aggressive about challenging where minerals are severed when there are certain protections. And one is there's basic language that's in the IRS regulations about limited and localized impact on the conservation values. You need that language in there, but we've been putting in there a clause where the land trust has a seat at the table for any surface use agreement that the surface owner negotiates with the oil and gas company. Now, the oil and gas company has the right to come on the property and develop the minerals. We know that. But most of your better, mature oil and gas companies are not going to just come on your property and start developing the minerals. This is Texas. You just don't go on other people's land. You could get shot. So your better oil and gas companies, and the vast majority of them, will enter into what's called a surface use agreement with the person that owns the surface of the land. It has your basic land title. And we write in where the land trust has the right to be a signatory to the surface use agreement. And Tom Kelsey does it this way, I believe, Tom, and I've done it this way for some time. And that way the land trust can sit down at the table with the oil and gas company and say, hey, let's use an existing road to access your drill pad. Let's keep the drill pad out of the wetlands. Let's keep the drill pad out of where the endangered plants are, and negotiate the oil and gas agreement that's going to be the best you can do for the conservation values of the property. And we've had pretty good luck lately getting those past the IRS. You know, I wish I could give you an answer with some certainty, but you know, for areas like this where there is oil and gas under the land, that's the best that we can do now, and it seems to be working right now. So, kind of a long-winded answer, and I hope that did answer the question. So, on to taxes. A key concept, a contribution of a conservation easement to a land trust may entitle the landowner to federal tax benefits. Okay, that's the good news. I'm going to give you the bad news right off the top, and that is a conservation easement is not going to reduce your property tax. If you've got land that's large enough to have good conservation values, you're probably already in ag, or you're probably already in wildlife that's a subsidiary of ag. The reason is you can't own that much land if it's not in ag. The property taxes would make it impossible to hold. So if you're already in ag, your taxes just don't get any lower than that. So a conservation easement is not going to lower your property taxes unless you're one of those rare properties that's at market valuation and not at ag. But it will reduce your federal income tax. The donation of a conservation easement creates a federal income tax deduction for the value of the conservation easement. So what's the value of a conservation easement? Value of a conservation easement is the value of the property before the conservation easement is on it, minus the value of the property after the conservation easement is on it, before and after. And another way to say that is it's the amount the conservation easement reduces the value of the property. So this is fair. The owner is giving up value in their property when they restrict it with a conservation easement, and they're being rewarded by the taxpayers with a tax deduction for giving up that value. Let's take an example. Joe Bob Badlands has a ranch that we're going to say, we're going to use a nice round figure. We're going to say without a conservation easement on it, it's worth $1 million. And with a conservation easement on it, it's worth $600,000. So what's the value of the conservation easement? $400,000. Congratulations. Good. The value of the conservation easement, the difference in the value before the easement and after the easement is $400,000. That's the value of the conservation easement. So the owner of the Badlands Ranch receives a charitable deduction of $400,000. Now notice I've got an asterisk by it because there are some limitations on the amount that can be deducted, usually on high income earners, so that they're not able to completely eliminate their tax liability with deductions. But for the most part, you're going to get a $400,000 deduction, and for the sake of our example, we're going to say Joe Bob Badlands gets a $400,000 charitable deduction. So I'm going to do the math for you. The deduction is not what the landowner cares about. What the landowner cares about is how much taxes am I going to save? And for a $400,000 gift, if Joe Bob has a nice round $100,000 income, his total tax savings are about $100,000 bucks. So he's given up $400,000 in value, and he's saving $100,000 bucks in taxes. So what is this AGI? Joe Bob Badlands' adjusted gross income, we're saying, is $100,000 bucks. What AGI, adjusted gross income, is everyone, I'm sure, is familiar with one of our favorite forms, IRS Form 1040 tax return. I'm sure y'all in the back row can all see this, but the very bottom line on the first page of Form 1040 is what they call adjusted gross income. And this is the income that your taxes are deducted from and that we're using for our calculations today. So let's say, yeah, Bob?
Is tax savings $100,000 or is tax savings a tax on $100,000?
If he donates $400,000 and his income is $100,000, his tax savings are going to be around $100,000. He's going to be in the 25 to 28% tax bracket. So 25 to 28% of $400,000, once he's taken all his deductions, is going to be around $100,000 bucks. Can I move on?
You can.
Thank you. So let's say Joe Bob has had a good year, and this year he's brought in $500,000. His tax savings are going to be, for the gift with a $500,000 income, are going to be around $150,000 bucks. So it is true that the higher income persons will do a little better with their donations. But we're talking about $100,000 to $150,000 of tax savings for a $400,000 loss in value here. So really, it's not about the money. I mean, the tax savings are an essential driver here. They're necessary to stimulate conservation easement donations and generate these gifts. But most of the people who are doing the donated conservation easements, they're doing it because they love their land and they want to see their legacy preserved. So without that, we wouldn't be in this game. It's not all about the money. Sometimes there is more money involved, where agencies, usually public agencies, have money to actually give cash to the landowner for the conservation easement. And we call these purchase of development rights programs. It's a fancy name for buying a conservation easement. And federal, state, and local programs will purchase a conservation easement from the landowner. And very often, the purchase price is less than the appraised value of the conservation easement. And we call this a bargain sale. And the reason I'm talking about this is there's quite a bit of this activity. These are really great deals for both the landowner and the public agencies purchasing the easements. The bargain sales are part sale and part charitable gift. What does that mean? Let's go back to Joe Bob and his conservation easement that's worth $400,000. If Claude and one of the local agencies get together and they pool money to purchase the conservation easement at 75% of the value of the easement, 75% of $400,000 is going to be $300,000 that Joe Bob's going to get in cash. that the PDR program, Purchase Development Rights Program, pays the owner in cash, $300,000. But notice the gift, the value rather, is $400,000. And so the $100,000 that Joe Bob is not